Chapter 10. Share-based payment. The contents to be covered in this chapter are as follows. Share-based payment. Equity-settled share-based payment transactions. Modifications, cancellations, and settlements. Cash-settled share-based payment transactions. Introduction. A share-based payment occurs when an entity buys goods or services from other parties, such as employees or suppliers, and Number 1. Settles the amounts payable by issuing its shares or share options. Or Number 2. Incurs liabilities for cash payments based on its share price. The main issue here is that when shares are paid as a consideration, there is not cash outflow, hence no revenue can be recognized. Types of transaction. Number 1. Equity-settled share-based payments. The entity acquires goods or services in exchange for equity instruments of the entity. For example, shares or share options. Number 2. Cash-settled share-based payments. The entity acquires goods or services in exchange for amounts of cash measured by reference to the entity's share price. Equity-settled share-based payment. Accounting treatment. Double entry. Debit, expense or asset. Credit, equity. The entry to equity is normally reported in other components of equity. Share capital is not affected until the share-based payment has vested. Measurement. Number 1. Transaction with employees or others providing similar service, then measure at fair value of equity instruments granted at grant date. Number 2. If the fair value of goods and services received can be measured reliably, they measure the fair value of goods and services received at the date they were received. Number 3. If the fair value of goods and services received can't be measured reliably, then measure at fair value of equity instruments granted at grant date. Timing. The vesting date is the date on which the counterparty, for example the employee, becomes entitled to receive the cash or equity instruments under the arrangement. IFRS 2 states that an entity should account for services as they are rendered during the vesting period, the period between the grant date and the vesting date. The expense recognized at each reporting date should be based on the best estimate of the number of equity instruments expected to vest. On the vesting date, the entity shall revise the estimate to equal the number of equity instruments that ultimately vest. The above can be diagrammatically represented as follows. Grant date. Vesting date. Vesting period is equal to, possibly same as, required service period. Charge fair value over the vesting period based on options expected to vest. Fair value determined at grant date. Calculate actual charge based on number that vest. Performance conditions. Apart from service conditions, some schemes also attach performance conditions to be satisfied before they vest. They can be classified into two types. Number 1. Market condition. When performance condition is related to market price of instruments. Example is to attain a minimum share price. Number 2. Non-market performance conditions are not related to the market price of the entity's equity instruments. Examples include EPS or profit targets. Cash-settled share-based payments. Examples of cash-settled share-based payment transactions include: Number 1. Share appreciation rights, SARs, where employees become entitled to a future cash payment based on the increase in the entity's share price from a specified level over a specified period of time. Number 2. The right to shares that are redeemable, thus entitling the holder to a future payment of cash. Accounting treatment and measurement. Debit, profit or loss, or asset. Credit, liabilities. The entity remeasures the fair value of the liability arising under a cash-settled scheme at each reporting date rather than fixing the fair value at the grant date like equity-settled scheme. The expense is recognized the same way as equity-settled scheme over the vesting period. Example question: Equity-settled SBP. An entity has a reporting date of 31st December. On 1st January 2011, it grants 100 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2013. At the grant date, the fair value of each share option is $15. During 2011, 20 employees leave, and the entity estimates that a total of 20% of the 500 employees will leave during the 3-year period. During 2012, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 employees will leave during the 3-year period. During 2013, a further 10 employees leave. Required: calculate the remuneration expense that will be recognized in each of the 3 years of the share-based payment scheme. Solution: the total expense recognized is based on the fair value of the share options granted at the grant date, 1st January 2011. The entity recognizes the remuneration expense as the employee's services are received during the 3-year vesting period. Year ended 31st December 2011. At 31st December 2011, the entity must estimate the number of options expected to vest by predicting how many employees will remain in employment until the vesting date. It believes that 80% of the employees will stay for the full 3 years and therefore calculates an expense based on this assumption. 500 employees multiplied by 80% multiplied by 100 options multiplied by $15 FV multiplied by 1 divided by 3 is equal to $200,000. Therefore, an expense is recognized for $200,000 together with a corresponding increase in equity. Year ended 31st December 2012. The estimate of the number of employees staying for the full 3 years is revised at each year end. At 31st December 2012, it is estimated that 85% of the 500 employees will stay for the full 3 years. The calculation of the share-based payment expense is therefore as follows: 500 employees multiplied by 85% multiplied by 100 options multiplied by $15 FV multiplied by 2 divided by 3, 425,000. less previously recognized expense, 200,000. Expense in year ended 31st December 2012, 225,000. Equity will be increased by $225,000 to $425,000, $200,000 plus $225,000. Year ended 31st December 2013. A total of 50, 20 plus 20 plus 10 employees left during the vesting period. The expense recognized in the final year of the scheme is as follows. 500 minus 50 employees, multiply by 100 options, multiply by $15 FV, multiply by 3 divided by 3, 675,000. Less previously recognized expense, 425,000. Expense in year ended 31st December 2013, 250,000. The financial statements will include the following amounts. Statement of profit or loss. Staff costs. For 2011, $200,000. For 2012, $225,000. For 2013, $250,000. Statement of financial position. Other components of equity. For 2011, $200,000. For 2012, $425,000. For 2013, $675,000. Example question. Cash settled SBP. On 1st January 2014, Growler granted 200 shares appreciation rights SARs to each of its 500 employees on the condition that they continue to work for the entity for 2 years. At 1st January 2014, the entity expects that 25 of those employees will leave each year. During 2014, 20 employees leave Growler. The entity expects that the same number will leave in the second year. During 2015, 24 employees leave. The SARs vest on 31st December 2015 and can be exercised during 2016 and 2017. On 31st December 2016, 257 of the eligible employees exercised their SARs in full. The remaining eligible employees exercised their SARs in full on 31st December 2017. The fair value and intrinsic value of each SAR was as follows. For reporting date 31st December 2014, FV per SAR $5. For reporting date 31st December 2015, FV per SAR $7. For reporting date 31st December 2016, FV per SAR $8. Intrinsic value per SAR $7. For reporting date 31st December 2017, FV per SAR $10. Intrinsic value per SAR $10. Required. A. Calculate the amount to be recognized as a remuneration expense in the statement of profit or loss, together with the liability to be recognized in the statement of financial position for each of the 2 years to the vesting date. B. Calculate the amount to be recognized as a remuneration expense and reported as a liability in the financial statements for each of the 2 years ended 31st December 2016 and 2017. Solution. A. The liability is remeasured at each reporting date based upon the current information available relating to known and expected levers, together with the fair value of the SAR at each date. The remuneration expense recognized is the movement in the liability from one reporting date to the next, as summarized below. For reporting date 31st 12/2014, workings 500 minus 20 minus 20 multiplied by 200 multiplied by $5 multiplied by 1 divided by 2. Liability SFP $230,000. Expense P&L $230,000. For reporting date 31st 12/2015, workings 500 minus 20 minus 24 multiplied by 200 multiplied by $7 multiplied by 2 divided by 2. Liability SFP $638,400. Expense P&L $408,400. B. The number of employees eligible for a cash payment is 456. 500 minus 20 minus 24. Of these, 257 exercised their SARs at 31st 12/2016, and the remaining 199 exercised their SARs at 31st 12/2017. The liability is measured at each reporting date based upon the current information available at that date, together with the fair value of each SAR at that date. Any SARs exercised are reflected at their intrinsic value at the date of exercise. Year ended 31st 12/2016. Liability brought forward 638,400. Cash payment 257 multiplied by 200 multiplied by $7, 359,800. Profit or loss, balancing figure 39,800. Liability carried forward 199 multiplied by 200 multiplied by $8, 318,400. Year ended 31st 12/2017. Liability brought forward 318,400. Cash payment 199 multiplied by 200 multiplied by $10, 398,000. Profit or loss, balancing figure 79,600. Liability carried forward nil.